All right, so recently I moved about 30% of my portfolio um, into short term bonds and REIT, just because I think that the market is way too high. Um, when you're looking at valuation and you're a value investor like I am, the values that we're seeing now is just crazy. I mean, it's been what the longest recovery expansion period in the history of the United States. And I just feel really uneasy about it. I've been feeling this way probably about a year now because in the spring, summer of last year, or was it in 2018? Actually, yeah, it's been 2 years. Um, since 2018, about the middle of the year, I felt, the middle to maybe the fall of 2018, I felt like the market was just way overvalued. And I made a move to cash, which at the time was actually pretty good because in December we had just a, uh correction that I thought was the sign of things, turning around and values uh, and prices getting more, back in line with their historical averages. And for a while that looked pretty good, but then maybe around April or something of 2019, so last year, um, the market recovered and did gangbuster. So I moved back into all equities and ended the year, right where the S&P 500 is. Um, Even though that's not my goal, I'm trying to beat the S&P 500, and for the last 15 years I have. Um, just last year was about even because I made that move. But when you're looking at the market with dividends reinvested and the returns are 29-30% or something like that, I think it's over 30% with dividends reinvested. And then you look at the Schiller PE ratio, the CAPE ratio, which is a cyclically adjusted price earning ratio. It's like the highest it's been. It is really crazy, and I just don't know that this is sustainable. So my gut's telling me that in the near term, and when I say near term, I'm thinking 6 to 12 months, um, we're gonna have some kind of correction again. So I made this move, and only time will tell if that's the right move or not. Now I'm saying this and putting it out there just for a couple of reasons because I did this not last year, 2 years ago because time's flying. But I think that last video was called something like, didn't we learn anything in the last 10 years, right? Because that was about 10 years on from the big recession of '08. And yeah, I'm feeling that way again because it just keeps going up and it's just not sustainable. So at least I don't think so. But I'm putting it out there again for a couple of reasons. Uh, One, you really shouldn't try to time the market. I mean, I do, that's part of what I try to do, but honestly, you shouldn't. And even I shouldn't. And a part of me doing this, putting it out there, is so that I can be accountable to myself um, and kind of remind myself that really I'm not as smart as I think I am. I mean, I know enough and I've done well over the last 15 years uh, in not doing index investing. But maybe that's just dumb luck. I've been beating the market. I'm gonna guess about 2% a year for the last 15 years. Um, the last 5 years has been really spectacular in terms of outperforming the market, just because I was heavy in stocks, tech stocks, and they've done amazingly well. I bought Microsoft when it was just dirt cheap, and Apple when it was under $100. Um, and they've gained a lot, just like other FANG stocks and whatnot. Um, I had my reasons for doing so. Um, Back when I bought Apple, I had resisted Apple for a long time, but earnings came up and they were just minting cash. But there was a point in time when the valuation didn't make sense. But at like $95 or something like that a share, and their PE was something like 12 or 15 with massive cash balance on the balance sheet, it just made sense to buy it from a value play. Same thing with Microsoft. Right after Ballmer left, I mean the stock was just beaten to shit. And at the time, I was looking at it and I was like, Office is still a big cash machine, and so is Windows. And to an extent, they reduced some since I bought it, but they're still making a lot of money. Now they're expanding that into, cloud services and whatnot. So the Windows empire and the Microsoft Office empire has been reduced, but they're making up for it with things like Office 365, which is a subscription base and all that. So at the time, I just felt like, there's still a lot of room to grow in Microsoft when it was just falling out of favor. And that's kind of the mindset for the value investor, right? And it's paid off. So to my point about, not timing the market and all that, because there is a saying that says, your time in the market is much more than trying to time the market. And I do believe that, and I try my damnedest not to do it, but I'm human as well, and I have feelings and emotions, and when I'm looking at some of these data points as a value investor, I'm just thinking to myself, man, this is ridiculous. So anyways, I moved into short-term bonds, corporate bonds. They're less than 3 months, so I don't have a lot of risk there, so it's almost like cash. And the other one that I moved into was a REIT that's paying a high dividend, but it doesn't have a lot of price appreciation, and it doesn't depreciate in price either. So it's relatively flat, and it's good for preserving capital, but my portfolio is now 30% in that. So my one reminder to myself is maybe I'm not as smart as I am or think I am. So I'm putting it out there, end of February. Just want to go back and look at it and see if it was the right decision. The second point, and this is why I mentioned Apple and Microsoft specifically, because I have about 22 stocks in my portfolio, is that I use personal capital to help track my net worth and all of my accounts. I do it on a spreadsheet too that's a lot more detailed and has projections and all that jazz. But personal capital is kind of like a really good quick glance at how you're doing. So I do use it. One of the features they have is they have like an investment analysis or whatever they call it. But they kind of look at your position, sectors, and all that jazz. And based on what you tell them, are you an aggressive or moderate growth investor or whatever, they kind of tell you how you're doing compared to like a basket of allocations that's recommended, right? And like I said, I'm not really an index investor. So I look at it just so that I'm aware and see where I'm overweight in certain industries or whatnot. But I don't really follow that. But the one thing that caught my eye was that there was one section in the analysis where they were saying that I had significant stock concentration risk. And basically what they were saying was that 5 of my stocks out of the 22 made up 50% of my portfolio, just over 50%. And they call that stock concentration risk. And when I look within those 5, Microsoft and Apple makes up 30%. They just do. When I bought them, they didn't. They were like, 5% of my portfolio each, maybe even 3 at the time. But they've grown gangbuster. My Microsoft has gained over 400%. Apple is, let me take a quick look here, 275%. So it's just ridiculous. Now, I do want to keep both Microsoft and Apple long term. So I don't think that I will be selling them, which will make my stock concentration even worse. I may pare back Apple because I don't feel they're as diversified as Microsoft, even though they get all the headlines. But that's a different story. But I'd asked this question on a Facebook group that I belong to about, is this a real risk that I have to worry about? And it kind of is, but then there was a response that basically said, well, if you bought it when it was reasonably priced and made up a smaller part of your portfolio, and really this gain is what's accounting for the concentration risk. In other words, because you bought low and the stock went up and now it's a bigger part of your portfolio, that's not as big a concern. And I kind of think that is the right perspective to look at it. But it did make me aware that I should be monitoring it a lot more closely, at least those 2, and decide if I want that, those many eggs in a small place. Um, so that's Apple and Microsoft. But with this whole, warning on stock concentration risk, it also made me think about, should I be moving some of my portfolio to just index investing? Because I've been successful with stock picking for a while. And certainly, I have certain advantages that I enjoy that the institutional investors, the funds and whatnot, uh, don't have, right? I literally can buy and hold forever if I want to. And a lot of times mutual funds and ETFs really can't. They're either tracking an index or they have investors who want their money out. And if you have a big investor that wants to cash out, you have to sell, even if you have a loss or whatever, right? So yeah, mutual funds, whatnot, they have certain constraints. I don't. I can just hold it forever. And that's kind of my philosophy as a value investor. Part of what I'm noticing is that there are a couple of stocks that I've been buying, it pays me a dividend, and I've reinvested, and the position has grown over time. But frankly, they haven't performed as well. One of these stocks is Omnicom Group. It's an ad conglomerate, but they've not done as well as I would have liked. Um, ConocoPhillips is another one where I have a big position, and they're mostly flat. I'm not losing money on it, but at the same time, I kind of am, because if you're flat in it for the last 3 4 years or whatever, that's lost opportunity, right? Um, 3M is another one that is actually down for me about 5%. Um, Pays a strong dividends, blue chip and all that, but I don't know if I really want to hang on to that long term. So maybe for those positions, I should liquidate and get into index investing, um, and then save my picks for the ones that I really want to hold, as individual stocks for the long term, like my Microsoft and others. Um, Part of the reason for doing this is that when I started this, I was 30, right? Because I'm now 45. And the time horizon when you're 30 is a lot longer, and you can afford to do some of these stock picking and hold forever, basically. Um, but as you get older and you get closer and closer to your retirement age, you should try to diversify even more. And even though I have 22 stocks and they're in all kinds of sectors, so from an allocation standpoint, the portfolio is fine at this point because I have things like industrials, consumer staples, and whatever, as well as my tech stocks. So it's not crazy, so it's pretty well allocated, but still, it's not as well as it could be in terms of allocation. And moving some of those funds to an S&P 500 index or even a total stock market index um, could make a lot of sense for me as I get closer and closer every day to needing the money to live on. Um, it could make sense. So that's the other reason that I want to kind of throw that out there. So some of this, I'm just kind of rambling, may not make sense for a lot of people. Maybe I'll give you some food for thought, especially, my thoughts on the market being overvalued and trying to get a little bit more conservative as I get older. Um, those are the two big themes in this video that may be helpful for you to think about in your own portfolio. But I'm doing this just as a think out loud exercise for myself, so I can go back, watch it, and kind of see the thought process that I have going on. So I think that I will do that over the next 12 months. Just get rid of some of these 22 positions and move to index funds, and really concentrate my time and effort on the ones that I really want to study, and hold on to those. So that's where I am. So I think I'm going to call this video, I'm not as smart as I think I am, because it's going to be a reminder to me that I shouldn't try to overthink things. I mean, certainly do your work, study, look at everything, but don't overthink it, right? It's just, sometimes not knowing is better, is the point, I guess. But in any case, 30% in short-term bonds and alternative assets that I can hopefully cash out and buy on the dip if it happens. But man, I just feel it that yeah, this is the year. Depending on what happens in the election in November, that could be the catalyst for a big correction. It could happen before then, depending on what the poll shows and all of that. Um, Coronavirus, all that crap. But yeah, I'm just waiting for that correction to come. In any case, thanks for watching and listening to me just kind of ramble on and kind of have this stream of consciousness. But hopefully you take those two big lessons away from what I said, which is I think the market is due for a correction. Is it this year or is it next year? I'm willing to bet you that by the end of next year for sure. But, I could be wrong. But personally, I feel it's going to be a lot sooner than that. And then the second one is if you have big allocations in some stocks in your portfolio, just look to see if you need to pare it back and evaluate it. So thanks for watching. See you again next time.